Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Hey, welcome to the Weekly Option. This is episode 5, but actually it's the first of our episodes that will contain actual trades. I know in the previous 4 recordings, hopefully you guys got a chance to listen to it, I just sort of walked through a few basic trade structures, trade strategies that I like to use. So figured I would start there and get it going today with a couple of trade ideas, and we'll come back next week and look at how they worked out and what I might have done different or better. So we'll start off the day just looking at the events of this last week. We had a pretty strong equity market situation here in the U.S. as companies started to report some earnings. We're in that season again, but we had the Dow Jones Industrial Average up 381 points on the week. So that's a pretty good start to second quarter. We also had the S&P 500 index up 43 points. And I think the biggest news of the week, one that certainly moved the markets quite a bit, started off the week with a lot more talk about the Chinese tariffs and possibility of a trade war with the U.S. And that's, as a guy with a background in commodities, well, I won't get into politics and protectionist economics, but I can just tell you that historically it's been challenging. So it'll be really interesting to see if how this all plays out, what tariffs actually do get put into place, and how the world, China and others respond. So we'll see. Hopefully it's all good for our economy here in the U.S. and doesn't hurt the global balance too much. We also had a few Russian sanctions and some, I guess we're going to start seeing the effects of the Syrian airstrikes. So quite a few things that could affect the market this upcoming week. I will mention them in this podcast, not really as a means of talking about politics. That is not my intent here, but they are things that affect the economy. For instance, I've spent a good chunk of years in the energy business, moving physical commodities around the country and around the world. When you start talking about tariffs, you start to create supply imbalances when you have larger supply because certain countries aren't taking our products due to reciprocal tariffs. Then what ends up happening is you ultimately should push pricing down, which sounds like it's a great thing unless, of course, you're the producer of said commodity. So we produce a lot of food and just a lot of everything here in this country. And, it'll be really interesting. So, but hopefully this all leads to a stronger U.S. economy, more jobs here, as well as a strong rest of the world to continue consuming our products, because let's be honest, we make a lot of products here and we really do need the world to still buy some of our stuff. So that's that. This upcoming week, I think one of the biggest things this upcoming week is the jobless claims on Thursday. That'll be a true indicator of how this economy is doing. Are we as strong as we've felt? I mean, last year was phenomenal, right? And hopefully we'll have similar gains in the economy this year. But these jobless numbers and some of the other big sort of economic data pieces give us an indication of what to expect from the Federal Reserve as far as making moves on the interest rates. And they can be, even though, jobless claims, many of these are lagging indicators. They sort of tell you how things were versus how they are. It's sort of an indication of how they are. It still can be very important to the economy and could very easily move this market around this week. As far as earnings expectations, we have quite a few big names having earnings this upcoming week. Bank of America, Charles Schwab, and Netflix on Monday. We have Goldman Sachs, IBM, and Johnson & Johnson scheduled to announce on Tuesday. We have Abbott Labs, American Express, Morgan Stanley on Wednesday, the Blackstone Group, and Philip Morris on Thursday. And then Friday has a whole slew, specifically, or a couple of them that I took note of, or GE and Procter & Gamble, and I almost missed Honeywell. So that's quite a bit of earnings this week. Sometimes those earning situations can create nice opportunities for us to trade around. So with that being said, might as well go ahead and dive into the trade ideas that I want to start off with this week. And my real goal with this show is to give some trade ideas that can work for people of varying strength and comfort in the options market. I view options as simple math and a great tool to either hedge risk or be able to put on or take a view in the marketplace for a very minimal amount of money. And so my goal is to limit risk and kind of know what my upside is. So one of the things you'll hear, the main things you'll hear me talk about, maximum loss. I want to talk about maximum loss even before I talk about maximum gain, mostly because if you don't know how much you can lose and you aren't comfortable with the idea of loss, then you probably should not be trading anything, let alone options. But as long as you know what your maximum loss is and you have an idea of what your maximum gains are, you can decide whether it's a worthwhile situation for you or not. And obviously there'll be, discussion of things like break-even point. And I should probably create some videos. I'll add some videos to the website and let you guys know when I do that. Just some basic training beyond the previous 4 podcasts. But break-even point is wonderful because that's the point at which you have neither made money nor lost money. And everything beyond that break-even point either is a win or a loss, depending on which kind of trade you have on. So those are some of the main metrics that I base my trades around. And, a lot of guys get caught up on the option trade. They get caught up focused on delta or gamma, vega, rho, and theta. And those all play a huge part in understanding options. I mean, I spent 5 years trading options, 4 of that on the floor, or a little more than 4 of that on the floor of the CBOE in Chicago, and then a bit of time at the Philadelphia Stock Exchange. I felt like I'd been banished, but that's a whole nother story for another day. But most of my time was there at the CBOE prior to getting my MBA from the University of Chicago. So I understand options. I understand the Greeks. And I also realize that the Greeks are the biggest factor that make people believe that options are complicated. And you have to realize the Greeks or any other risk metrics are there to help you. If they are an actual hindrance to your understanding, then something is wrong. And so the way you'll hear me talk about options is really, we'll call it Greek light or even Greek free at some points, because honestly, if you're not hedging your position, then your Greeks don't matter. And for most of you, this podcast for the most part is for the mom and pop investor. This is for the guys for the folks out there who want to get active in option trading or want to find another way to add some money to their portfolio or income to their lives. This podcast is for you. And I'm not targeting the Wall Street trader here. A Wall Street trader who has millions of dollars in positions on, probably has everything hedged so that you isolate specific dynamics like trading volatility, or maybe you're actually trading price move at some point, or you're looking for a delta neutral spread that's actually going to capture theta but be kind of vol neutral. I mean, there are all sorts of things that can be. This podcast probably is not for you because I'm not going to speak about options like that. You can email me, you can call me, we can go all day. I love talking shop about options, but at the end of the day, this podcast is for Main Street, not Wall Street. I want more people having an idea of the tools that are out there for you to move ahead and get ahead in your finances and in your retirement income or your nest egg or whatever it is that has you here listening and learning and talking about option trading. So this podcast is for you. Without further ado, let's dive in. We'll start off. So I mentioned that Bank of America has a earnings call on Monday, and I was looking at them for the covered call scenario. So if you remember, I believe in podcast 1 or so, I talked about covered calls. It's basically where you are long the stock. You already own the stock, or you decide to buy the stock and you decide to sell a call against it. So it's covered because for every option that you have, that option when you sell an option, you have the obligation of selling 100 shares of stock at that strike price, but you only have to worry about that when it gets in the money. We're going to do that against stock that's already in the account. So if you have 100 shares on a Bank of America, or you decide to buy 100 shares, you could sell the call and create this covered call scenario that I'm looking at. So for the month of May expiration, which is May 18th, I believe, we're not looking at April expiration for the most part. That's Friday. It's just a handful of days away. Most of the time value has already been taken out, so you really are just trading specifically for intrinsic value. And I'll put a video up so that everyone understands the difference between intrinsic value and time value. But essentially, the price of an option is based on two components, and that's the intrinsic value and the time value. Now, you can get more complicated. I know anyone who's saying that. You can get more complicated. You can add in volatility. You can add in everything else. Trust me, I have all of the models. I have more books on models here, option models. But again, we don't need that for the mom and pop investor. So what we're really looking at right now is, if you own 100 shares of Bank of America, you're going to be able to sell one call against that. So 100 shares Bank of America that closed on Friday at $29.80. And I'm looking at the May 31 call. You'd be able to sell that on Friday. That closed with a bid of 55 cents. So we'd be able to sell that call at 55 cents. So we collect $55, right, for selling that option. And ultimately, if the price moves up through our strike, right, if price B of A has a great run and the price goes above $31, then we're going to have to hand over our stock, and they're going to exercise that call against us. So that's where we hand over our stock. Ultimately, we're going to end up essentially locking in a 5.8% move in the stock if we have to give our stock away. And that's from now until May the 31st. So you're really talking, I'm sorry, not May 31st, May 18th. So you're really talking about 4 weeks or so, 4.5 weeks of risk to be able to add $55 to your account, plus be able to lock in a sell of those shares. So your maximum loss is always interesting on the covered call. And I have seen these go the wrong way before. Your maximum loss is actually the entire value of the stock. So $29.80 is where stock is trading right now. We're ultimately going to be looking at selling one call for 55 cents, right? So that'll lower that price to $29.25. That's going to be our break-even price. So your maximum loss is the price of B of A stock going all the way to zero. So $29.25 per share times 100 shares, you're looking at a maximum loss of $2,925. But that loss is on your stock, not on the option. Right? So what happens if B of A has sort of mediocre earnings and it doesn't move at all? Let's say it stays at $29.80. You still get to keep that 55 cents. And I said $55 earlier. That's because an option is based on 100 shares of stock. So it's 55 55 cents per share times 100 shares of stock equals $55. So that stays in your account. So you get paid just for having that stock in your account. This is a great, covered calls are great for stock moves, stocks that are trending, stocks that aren't doing much, stocks that are going down. Let's say you own some shares of a company you really don't want to sell, maybe because of tax basis, maybe you just have a sort of affinity, a true belief in this company, and you don't like the idea of selling. Selling calls against that stock can be a great way of still creating some income and actually making money month by month, even though the stock itself isn't yielding the return that you like. So that's going to be trade number one. If all works out, if B of A stock, goes up higher than 31, the stock price at 31, then all in all, with the stock move and the money you collect on the stock, on selling that call, you'd be able to lock in a 5.8% move in a matter of 4 weeks. So not bad. Next trade we're going to look at, trade number two. It's going to be a little more complicated. This time we're going to look at a credit spread. We're going to sell a call spread on the S&P 500 ETF. I'm a big fan of ETFs. They function more akin to stock versus having to trade an option on the E-mini S&P futures contract. These ETFs will provide plenty of trade opportunities for you, and you don't have to worry about ever getting exercised into cash on an underlying futures contract or something like that. So on Friday, the SPY, which is the spider, as it's affectionately known, the spider ETF closed the day at $265.11. And we're going to look at selling the May 270-271 call spread for 35 cents. So typically I try to collect 30% or more premium on my call spreads. So this spread in particular, we'd be collecting 35 cents on $1 of risk. So a call spread can never be worth more than the difference between the strikes. Since we're looking at the May 270-271 call spread, that's only $1 ride. That means that we're collecting 35% on our maximum risk. So the maximum amount of loss that we can have on this trade is 65 cents. I got that by subtracting the 35 cents that we collect from that $1 maximum value for the spread. So for every spread that you put on, you're going to be receiving 35 cents. Of course, that's times 100 shares, so $35. Just making sure everyone's on the same page. That's going to put our break-even price at 270.35. So if you were to exit this trade or wind it down or hedge it any time prior or any price below 270.35, you're going to make money. The moment it goes to say $270.50, then you're actually losing money on the trade. You'll start to lose money, and the maximum amount you can lose is that 65 cents, or the remainder of the value of that spread, the remainder of the maximum value of the spread. So that's pretty much it. I love trading these, and of course, those of you who are familiar with trading credit spreads, you know that you can also find a put spread to sell against this as well, so that either way, when the market moves, you're going to have one side that definitely makes money and another side that will either lose money or not make as much money. So before you try to hedge it or make another trade. So we'll walk through that a little bit more later on. Iron condors, as it's affectionately known, or more commonly known, selling a put spread and a call spread. I'm not going to discuss that right now, but certainly something to think about as you're learning about options. And I'm going to talk about this next trade really quickly. I really want to wrap the show up. I don't want them to go too long, but like I said, I could talk all day about options, so I don't want to bore you guys. So trade number 3 is going to be a debit call spread. And this is one of those that a lot of people don't look at too often, but we're going to look at the Diamond ETF. That's the ETF for the Dow Jones Industrial Average. So DIA is the stock symbol. Diamonds stock closed Friday at $243.58. We're looking at buying a 242.244 call spread for 98 cents. So we're buying a call spread that has a maximum value of $2. We're going to buy it for 98 cents. So the good thing about that is when we buy options, our maximum loss is what we pay for it. So maximum loss on the spread is 98 cents. The maximum gain, of course, is going to be $2, the difference between the spread, between the strikes, minus the 98 cents that we collect. So maximum gain is $1.02, leaving us a little, roughly 104%, 104% maximum yield on this trade. The beauty of it is the in the money call that we're purchasing has some intrinsic value, and by selling that slightly out of the money call, we actually are basically financing that in the money call and being able to put on a position that should do pretty nicely. So that was also for the month of May, the May 242.244 call spread, buying it for 98 cents, hoping for a maximum gain of $1.02. And we have a break-even price of about $242.98. So that's it for this week's episode. Look forward to having you join me next week. Make sure you subscribe. Definitely want to have you guys hear the other episodes as they come out. And in the coming weeks, I'll be sending you or letting you know that we have more information on the website. There'll be a newsletter and also more training videos. So that's it. Have a fantastic week. Happy trading. We'll talk to you soon. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.